Hello, I'm Julie Price and welcome to Juniper's second quarter 2023 economic review. Thank you very much for joining me. The U.S. economy proved more resilient than many anticipated in the early months of 2023. Stronger than expected economic data, inflation concerns, and a still tight labor market sparked fears of higher rates for longer. Risks of a policy-induced recession rose, and markets became more volatile after a strong start to the year. The failure of Silicon Valley Bank and several other regional banks contributed to new bouts of market volatility and raised concerns about the health of the U.S. banking system, the potential for a wider fallout, and the risk of recession. Despite these banking concerns, the Federal Reserve continued to tighten policy at its March meeting, raising interest rates by an aggressive 4.75% in just a year since the tightening cycle began. The Fed does seem to be near the end of rate hikes, but tighter financial conditions and the regional banking crisis have narrowed the window for a soft landing, particularly as the economy continues to confront challenges posed by lower household savings, poor sentiment, and a strong dollar. Even considering the twists and turns of this quarter, many sectors of the markets have still posted gains year to date. Moreover, last year's market corrections have left valuations at still very attractive levels compared to history. The questions are for investors are when to take advantage of these better valuations and which areas to overweight or underweight in a still very complicated macro environment. In particular, we assessed the performance of this past year for markets and economy, considering trends in growth, jobs, inflation, profits, the rest of the world, and the US dollar. This is followed by comments on the outlook for monetary policy. Finally, we consider the implications of all this for those investing across asset classes and highlight the importance of taking a balanced view to asset allocation. Any investment strategy should start with a broad assessment of these fundamental issues. To help us out, we turn to JP Morgan's Guide to the Markets. Join me while I discuss these topics and more. In the first quarter of 2023, the collapse of Silicon Valley Bank and several other regional banks sparked concerns regarding the health of the U.S. banking system and the potential for a wider economic fallout. Regional bank turmoil has been worrying, but we do not need to fear a repeat of the 2008 financial crisis. The management of deposits and the concentration of the depositor base were unique problems that acutely impacted Silicon Valley Bank and led to their downfall. These issues will play a role in debate about regulations for small and medium-sized banks. On the left side, we show bank capitalization, which still looks healthy overall and has improved significantly since 2008 due to the impact of stricter bank regulations following the global financial crisis. Still, the regional banking crisis will likely have negative implications for the U.S. economy. As the chart on the right shows, lending conditions have tightened meaningfully since the second quarter of 2022, and we expect the banking turmoil will cause them to tighten further. This will be a drag on overall economic growth by reducing capital available for business spending and investment. As we enter the second quarter of 2023, financial distress from regional bank turmoil has created new headwinds for the U.S. economy and increased the risk of recession later this year. Business spending in particular could be hurt for two reasons. First, businesses may slow hiring and capital spending plans due to increased recession worries. Second, we are very likely to see a further tightening of bank lending conditions as banks focus on the quality of their balance sheets rather than on growth. Consumers, on the other hand, will be largely unaffected by the bout of financial instability, but higher inflation and the lagged effects of less fiscal stimulus will continue to weigh on consumer spending. This year, this personal savings rate has only averaged 4.7% compared to its long-run average of 8.9%, and consumers have been running up their credit card balances. The single-family housing market, while a relatively small part of the economy, has come under pressure from higher mortgage rates. Fortunately, there is a limit to how much further this can fall, given we still have historically low housing supply. On trade, a moderation in dollar and an improved growth backdrop for some of our major trading partners may support U.S. exports. Overall, the banking system turmoil has underscored the vulnerabilities of an economy facing a rapid rise in interest rates in a very short period of time. As the economy confronts these challenges, we will likely see weak real GDP growth with a greater than 50% chance of tipping into recession by the end of this year. The labor market continues to be a bright spot in an otherwise gloomy environment, with the unemployment rate at 3.6% as of February, just 0.1% above its 50-year low in 2019. However, the economy, even in the labor market, is losing momentum. Job openings have come down and will likely fall further as businesses reel back hiring efforts in the face of slower demand and higher costs. Layoff announcements have also risen. Importantly, this has contributed to a moderation in wages, which only grew by 0.2% month over month and 4.6% year over year in February, making it the 23rd consecutive month in which wage growth has lagged inflation. There is also a limit to how much the unemployment rate could rise going forward, as U.S. businesses still face a structurally smaller labor force than prior decades. Diminished legal immigration, particularly over the course of the pandemic, and baby boomers reaching retirement age have left the economy short of workers. As such, the unemployment rate may only nudge slightly higher in the year ahead. However, wage growth should continue to moderate and help give the Federal Reserve confidence that inflation is sustainably coming down. Last year, higher costs and receding demand led to a slump in corporate profits relative to a spectacular 2021. In the fourth quarter, S&P 500 operating earnings per share were down 13% from a year earlier and down 6% for all of 2022. Looking forward, consensus expectations for a double-digit gain in earnings this year look too optimistic, and earnings will more likely be flat to down relative to 2022. Rising costs rather than deteriorating sales have caused weakness in earnings, and pricing powers should continue to differentiate winners and losers in 2023. Energy companies will continue to benefit from high margins, while businesses that provide essential goods and services should be supported. Elsewhere, rising labor costs, higher interest rates, and slowing nominal sales growth should bite into profits. In addition, a much higher dollar poses a headwind for companies with overseas sales, and recession concerns could cause management teams to further reel in spending and investment. A recession would, of course, cause profits to fall further, and lower inflation tends to coincide with lower corporate profit growth, posing an additional headwind in the year ahead. However, if a recession that eventually leads to less wage pressure and easier monetary policy materializes, it could set up for a better long-term environment going forward. This slide shows that in every recession since 1960, the unemployment rate in purple increased during recessions, shown in the gray area. Look at each chart. We're consistently seeing this phenomenon, even with the latest pandemic recession. However, in today's environment, where we are being threatened with another recession, the unemployment rate is extremely low at 3.6% compared to a 50-year average of 6.2%. A sustained inflation downtrend is now underway after hot inflation squeezed consumer wallets for the better part of the last 2 years and contributed to a swift rise in interest rates. Headline CPI inflation has come down from its peak of 8.9% year over year last June to 6% in February. As we show here, a modest monthly pace of inflation has been mostly sustained for the past 8 months. Importantly, the major hotspots of inflation from the last 2 years have now simmered down. After Russia's brutal invasion of Ukraine sent global commodity prices soaring in early 2022, energy prices have been declining since the second half of last year. Improved supply chains and lower consumer demand have also allowed inflation to ease across core goods categories. While shelter inflation remains elevated, this reflects a lagged effect reality as rental increases have generally stalled for new transactions in the rental market. The remaining problem for inflation is core services prices outside of housing, a measure Chairman Powell has frequently quoted when referencing inflationary pressures. This measure remains elevated due to a tighter labor market and the lagged effects of some of the same supply issues that impacted core goods prices. Fortunately, easing labor market tightness and consumer demand should allow this measure of inflation to come down, particularly in 2024. While inflation may not be falling as fast as the Fed would like, it is gradually falling to much more manageable levels. We expect CPI inflation will decline to 4% year over year by the end of this year and towards 2 to 3% by the end of 2024, even without a U.S. recession. This chart shows that many of the same economic pressures that have caused inflation in the U.S. are present throughout the world. Blue represents the lowest inflation levels, and red represents higher values. Supply chain disruptions, mainly due to the pandemic, as well as fiscal stimuli throughout the world, have made this a global trend. Some larger emerging economies are not experiencing inflation like many of the developed markets are seeing. Producer input prices have been steadily falling, helping manufacturing countries like India and China emerge from the pandemic with less inflationary effects. China is also coming off strenuous efforts at controlling COVID-19 last year, which disrupted production and suppressed demand, keeping price pressure contained. And if the U.S. does enter a recession, emerging market central banks will have to keep rates high to protect their currencies from the impact of outflows. Otherwise, rising import prices will push inflation higher still. Just a year into tightening, the Federal Reserve has hiked rates to a target range of 4.75 to 5% to try and accelerate the decline in inflation. Despite emerging financial strains, the Fed hiked rates by an additional quarter percentage point at its March meeting, but its forward guidance signaled the end of the tightening cycle is near. In particular, the Fed's dot plot revealed the potential for another 0.25% rate hike, but also that this hike would likely be their last. Thereafter, rates are expected to fall in 2024, but remain at restrictive levels. While the median expectation was unchanged for 2023, some policymakers are becoming more hawkish, and the divergence between projections has widened, perhaps underscoring the level of debate occurring among the Fed members. The Fed's updated economic projections showed a slightly more dovish picture of weaker growth, a touch higher inflation, and slightly lower unemployment compared to previous projections. The median expectation for the annual core consumption deflator rate is now slightly higher for 2023 and 2024 versus its December projections. Other revisions suggest that the Fed believes below-trend growth and an increase in unemployment will be necessary to combat inflation, and that a soft landing is becoming less likely. Interestingly, futures markets disagree with the Fed's policy projections. Despite Powell opposing the idea of rate cuts, future markets have priced in cuts for the second half of 2023, reflecting the concern that overly aggressive monetary tightening could tip the economy into recession. The Federal Reserve is not the only central bank tightening policy this year, as elevated inflation has been a global issue. This slide shows the path of monetary policy for the Fed, European Central Bank, Bank of England, and the Bank of Japan. These banks are expected to continue to wind down their balance sheets and deliver additional rate hikes in 2023. However, as inflation pressures subside and tighter credit conditions threaten the global outlook, markets expect looser policy to follow shortly thereafter. In Europe, business confidence improved and economic activity rebounded during the first quarter after an energy crisis failed to materialize, contributing to underlying inflation pressures. This has prompted monetary tightening, with the ECB and BOE delivering additional rate hikes in March, bringing their respective policy rates to 3% and 4.25%. However, with recent turmoil in the European financial sector, the ECB delivered more dovish forward guidance that has lowered expectations for further tightening. On the other hand, Japan has been the exception to the hawkish rule. After widening its yield curve control tolerance band in December, the BOJ has held its key policy rate in slightly negative territory. In the months ahead, the exact path of global policy rates remains unclear. It is clear, however, that global tightening efforts have brought rates to much more normal levels. In Europe, for instance, rates have finally emerged from their negative rate purgatory and are expected to remain positive going forward. This, combined with the global thrust of tightening, will have important implications for the global investment landscape. A long cycle of U.S. dollar strength is likely coming to an end. After reaching a 20-year high last September, the dollar had fallen by roughly 8% through late March as the forces that contributed to a rising dollar last year are now receding and potentially paving the way for a new cycle of dollar weakness. Specifically, narrowing interest rate differentials and widening growth rate differentials will likely weigh on the dollar. After the Fed's aggressive tightening campaign caused interest rate differentials to widen in 2022, a forthcoming Fed pause and continued global tightening efforts have led to a narrowing in differentials. Additionally, better than expected growth in China and Europe and the increased probability of a U.S. recession suggest further downward pressure on the dollar as global growth looks set to outpace the U.S. Moreover, long-term fundamentals pose a headwind. This slide shows the U.S. trade deficit now amounts to 3.2% of GDP. This partly reflects the negative impact of the dollar on the competitiveness of U.S. manufacturing and should help push the dollar down going forward. As U.S. demand for overseas goods, services, and assets increases the demand for other currencies. Over the long run, we expect economic forces to gradually drive the dollar down. In the near term, narrowing growth and interest rate differentials should prevent any sustained periods of appreciation. However, the dollar remains a safe haven asset and could still see bouts of strong performance during periods of uncertainty. Volatility continued to challenge investors in the first quarter as financial sector weakness, elevated inflation, and an uncertain outlook for monetary policy sent markets through twists and turns after a strong start to the year. However, many sectors have still managed gains year to date, which has been a welcome development after last year's losses. The matrix page shows positive performance across a broad mix of global stocks and bonds for this year. But beneath the surface, some sectors are holding up better than others. Indeed, volatility during the first quarter specifically pressured U.S. equities, while international markets are now outperforming. U.S. equities may face further challenges in the year ahead, particularly if a recession leads to deeper earnings downgrades. Above average wage inflation, contracting margins, and a slowing growth pose additional headwinds and emphasize the need for active management as investors seek to identify high-quality sectors and companies best positioned to weather a mild recession and deliver strong long-run returns. Outside of the U.S., steeply discounted valuations and a weakening dollar suggest that international equity outperformance should continue. Core fixed income also continues to look attractive as mounting growth concerns and the potential for rate cuts in the year ahead mean that bonds offer income, capital appreciation, and diversification benefits once again. As we consider the risk on the horizon, it is important to appreciate the benefits that diversification has offered. While stock-bond correlations continued positive last year, the end of the Fed's tightening cycle and subsiding inflation should allow the traditional negative relationship to reassert itself. As this slide implies, it is very challenging to cherry-pick the best and worst performing asset classes each year, but a diversified portfolio has delivered investors a smoother ride with solid returns over the long run. Last year, elevated inflation and tighter financial conditions across the globe sparked a global reset in valuations that spared few asset classes. While equity markets have improved and bond yields have fallen this quarter, the current landscape still presents a much more attractive slate of investment opportunities than existed at the end of 2021. On this slide, we show 10 of the major asset classes and styles and their valuations expressed as Z-scores versus their respective 25-year history. This allows us to illustrate how normal or abnormal current valuations are. As you can see, asset classes across the board are pretty much cheaper today compared to the end of 2021, but by varying degrees. Fixed income still looks attractive as U.S. Treasuries, core bonds, and municipal bonds remain below their average valuation levels. International equities are being offered at a historical discount, while some areas of the U.S. market, specifically large cap and growth, still look slightly expensive. When positioning portfolios for the remainder of 2023 and beyond, it's important to assess the remaining risk on the horizon, as well as the menu of opportunities presented in the aftermath of last year's market correction. It may serve investors well to lean into the cheap areas of the market, remain selective in the expensive one, and position towards those opportunities poised to drive long-run returns beyond the cycle. After rising inflation, tighter policy, and Russia's invasion of Ukraine drove consumer sentiment to record lows in 2022, fears of an impending banking crisis and a slowing economy posed new threats in 2023. While sentiment has staged a modest comeback since last year, increased risk of recession may keep consumer sentiment depressed this year. When investors feel gloomy and worried about the outlook, their natural tendency is to sell risk assets in general and stocks in particular. However, history suggests that trying to time markets in this way is a mistake. This page shows the University of Michigan Index of Consumer Sentiment stretching back over the past 50 years with 8 distinct peaks and troughs noted. We also show how much the S&P 500 went up or down in the 12 months following the peaks or troughs. On average, buying at a confidence peak yielded a return of 4.1%, while buying at a trough returned 24.9%. This is not to argue that U.S. stocks will return anything like a 24.9% return in the year ahead. Many other factors will determine that outcome. However, it does suggest that in planning for 2023 and beyond, investors should focus on what they own and valuations rather than when to buy and to sell and how they feel about the world. The MSCI EAFE, representing developed markets in Europe, Asia, and the Far East, has finally overtaken the U.S.'s strong performance after 14 plus years. JP Morgan publishes the outperformance regime change when there is sustained outperformance of one region over the other for a cumulative 12 months. Europe, in particular, has fared much better than expected over the last several months as the anticipated energy crisis did not materialize due to energy stockpiling in a mild winter. A falling U.S. dollar has also helped, known as the currency effect. Valuations are much more attractive across the globe, which we explore next. Looking at global valuations on the right, the U.S.'s 12/31/21 valuation in Navy is much more expensive than the 25-year average, as represented by the purple bar. Valuations in the U.S. have been consistently high for years, but with the market's less than stellar 2022 performance, the current ratio in turquoise has gotten cheaper, just above the long-term average. Most countries around the world experienced a tough 2022 as well, further decreasing already cheap valuations, making them even more attractive for bargain hunters. So because of the cheaper valuations, declining dollar, and more favorable economic conditions, you may have noticed an increased allocation to international equities in your portfolio. Thank you very much for making it all the way through this quarter's review. As always, please feel free to reach out to me to review this and more.